is your view that the Russell will continue outperforming throughout the second half of the year because the 493, the Unmagnificent 493, will start doing better? Is that your view?
I think it'll not only outperform for the second half of the year, I think it'll outperform for the second half of the decade. So Powell is not the right guy for the job right now because he doesn't understand history. You're not going to cut your way to prosperity, and cutting your way at this point will create a slowdown in the economy, which is going to take more stimulus. So there's only one way out, and it's going to be massive growth and running nominal GDP hotter than we have in decades.
We're speaking now with Thomas Hayes, managing member of Great Hill Capital. We'll be going over his market outlook. Thomas has been on my show several times. He's been one of the more accurate guests in his predictions. So let's see what he has in store for us today. Welcome back to the show. Thomas, good to see you.
Great to see you as well. Thanks for having me back, David.
Tom, let's start by taking a look at what's happening today. Let's take a look at the budget bill that's being voted on right now as we speak on the 2nd of July. Trump's budget bill is close to becoming law. This is from the BBC. Trump's massive tax and spending budget bill is returned to the U.S. House of Representatives as the clock ticks down to the president's 4th of July deadline for lawmakers to present him with a final version that can be signed into law. So it looks like it's happening. The bill nearly cleared the Senate or upper chamber of Congress on Tuesday. VP J.D. Vance cast a tie-breaking vote after more than 24 hours of debate and resistance from some Republican senators. Let's take a look at what this tax bill, this big, beautiful bill, means for not just Americans, but also investors. Now, Trump has vowed to cut spending. I don't know if he's just going 180 on that or if this is a part of a bigger plan. I'll let you evaluate it.
Yeah, look, it's a negotiation, and politicians' number one job is to get reelected. And the way they get reelected, the Congress people and the senators, is to bring home the bacon. So he can't get what he wants without helping other people get what they want. I think at this point, with debt to GDP 120%, you're not going to cut your way to prosperity. And cutting your way at this point will create a slowdown in the economy, which is going to take more stimulus. So there's only one way out, and it's going to be massive growth and running nominal GDP hotter than we have in decades. And this bill is the foundation of doing so. This, coupled with deregulation, if you look, and it's the way we did it in the 50s. So we had 120% debt to GDP following World War II. We borrowed a ton of money to fight a visible enemy. Here, in the sense of COVID, we borrowed a bunch of money to fight an invisible enemy, and then we kept borrowing more and more even after the enemy was vanquished. But we are where we are, and the only way to fix it and bring debt to GDP levels down, cut them in half like we did in the 50s, is running growth above trend. And by the way, we ran inflation above trend in the 50s. So Powell is not the right guy for the job right now because he doesn't understand history. Inflation is going to have to run around 3% for us to have nominal growth 4 or 5% and get debt to GDP down to 60%. This bill sets that stage with or without Powell. You've got the $1 million mortgage interest deduction, which is a good thing for housing. You got the $5,000 credit. I'll tell you, I think what's interesting, no tax on tips. He promised that in his campaign. That's fine. But the $10,000 interest deduction on auto loans for new cars built in America, I think, is a big deal because you haven't seen the auto volumes recover to pre-COVID levels like you do every cycle for the last 50 years. And this is going to accelerate that. The reason that's important, that creates a lot of high-paying manufacturing jobs in the U.S. and all the ancillary benefits. The average car on the road is 13.5 years. So not only are the OEMs like Ford, GM, et cetera, going to start to flourish from something like this, but all the auto parts suppliers, which have been kind of left for dead because the volumes have been anemic, are going to start to accelerate. That's a lot of middle America jobs. And if Trump 2.0 is anything like Trump 1.0, the real beneficiaries of his policies are everyday working people. Real wages rose dramatically in his first term. And I think we're going to see more of that in the second term. Then you take the baby investment accounts at $1,000 a pop. If you have a baby between 2024 and 2028, $1,000 goes into a IRA type of instrument so that new babies can participate in the American dream. They wake up at 20 years old, 30 years old, 35 years old. They've got a down payment sitting, waiting for them for housing and family formation. They've got capital to maybe start a business, further their education, et cetera. That is a great thing. The headlines are all about no one's going to be able to use hospitals and no one's going to get any food stamps. It's not quite that black and white, but it is a trade-off. They are making some cuts to places, permanently cut the Tax Cuts and Jobs Act tax benefits. It's huge. Will continue to spur growth. So there's a lot of great stuff here, state and local. They were able to negotiate that up to 40,000, so the people on the coasts are happy. But Hassett, the net effect, Hassett claims and believes it's going to add $10,000 of income per household over time. And you have that type of money, American consumer, you can never bet against them. When they have money, they spend it.
This is an article detailing some of the key items of the bill. Let's take a look at some of these. A look at the key items in Trump's big, beautiful bill: Social Security taxes, vow to eliminate taxes on Social Security income, more Medicaid requirements, changes to Medicaid, food benefits reforms have been added to the Supplemental Nutrition Assistance Program, which is used by over 40 million low-income Americans. No tax on overtime or tips. You've mentioned that. Clean energy tax cuts. One of the most notable divisions between House and Senate Republicans is the Senate's proposal for clean energy tax breaks. So what happens next? Which of these items, or perhaps others, stood out most to you?
Well, look, there's nothing good in that article, right? I mean, the only thing that Musk has gone apoplectic about this is because a lot of the green tax credits are getting cut, and it's subsidized the business for many years, and he's done amazing things because of it. But 15 years is a long runway to continue to subsidize. At some point, if there's validity in the business, it's got to stand on its own legs, and I think it will. And I think it's going to hurt his competitors more than it's going to hurt him, and he's going to be the leader in EVs. So that's part of the give and take as far as the cuts go, as far as the puts and takes. I've covered the benefits, you've covered the costs, but net, it fosters growth.
How stimulative is this bill? In other words, is this the fiscal impulse that we need for basically a return to nominal highs in GDP growth?
Yes. I actually co-hosted a show and interviewed this economist who put out a report that addressed this specific issue. He says in its current form, and he was kind of, generally bearish. He said it'll add 40 basis points to GDP as it currently stands. I think it's underestimating the multiplier effect of these things actually winding up in the economy. For one thing, if you look at the mistakes that Powell has made holding back the housing recovery, that's 16.2% of GDP is housing. 72 million millennials can't get their family started. The average housing starter home purchase is now pushed back into the late 30s. That's awfully late to have kids and start a family. And it's because of this unnecessary 200 basis points of restriction by Powell. So if he doesn't cut in July, the solution is very simple. Trump is going to announce some dovish person as his successor, and the market's going to immediately discount 200 basis points of cuts. Powell will be sitting a lame duck. He's welcome to sit in his chair for another year, but he will have zero power, zero influence, and zero effect. Alternatively, he can take the right action and move to the data dependence business, which is the mandate of the Fed, versus the prediction dependent business, which now he thinks he's a forecaster. But if he looks at his own forecast in the summary of economic projections, he acknowledges that it's a temporary bump. And if that's the case, he should have already been cutting. He also acknowledges, or if he believes his own predictions, he should look at his prediction for real GDP at 1.4%. If he actually believes his own predictions, he should have cut 50 basis points in June.
Well, the Powell press conference, the FOMC press conference rather, last time was quite dramatic to me, at least, listening to the FOMC press conference, because Powell directly stated that he sees inflationary pressures coming. And I think that was, as clear and direct as you can get from the Fed chairman. I don't know if you agree with that
Well, listen, he also believed that quantitative easing should be on autopilot in December of 2018 and crashed the market 20% in 3 weeks before Christmas until Mnuchin called all the banks on a Sunday night and bailed them out. He also believed that inflation was transitory when we know it wasn't, and was behind the curve. So it's too late, Powell. Look, the guy's a great business person. I hear he's a great golfer. He plays over at Congressional. He probably would have been a great Treasury Secretary, but he has no feel. He's in the wrong position, and he's being rigid because he read a book about Arthur Burns in the 70s. The conditions, the economic conditions, the demographic conditions are nothing like they were in the 70s. And rather than holding tight to quote unquote preserve his legacy, he's got an opportunity to go out like Seinfeld, cut rates, stop screwing 72 million millennials, stop screwing 300 million taxpayers who are spending $600 billion on interest that they don't need to on interest. That's just the interest on U.S. debt, not to mention their interest payments in their everyday life, whether it's auto loans, student loans, trying to refinance a house, to buy a house, et cetera. All of that is a huge governor and restriction on the economy that doesn't need to happen. If we're going to grow our way out and get things in balance, debt to GDP, inflation's got to be higher, not lower. It's got to be 3.5, and we got to inflate some of the debt away, and we've got to have growth above that level in order for the formula to work. Otherwise, you cut and you slow things down, and you have this 200 basis points of restriction, 200 basis points Fed funds rate above the rate of inflation, and all that's going to happen is you're going to increase debt to GDP because you can't get growth levels at the levels you need them to bring that ratio down like we have in the past. And he just is unwilling to see it, or he's has other reasons for being belligerent, but it's hurting 300 million
Political
people.
Even
if it's only intended to hurt one person, it's hurting more than 300 million people in a meaningful way.
Well, it does beg the question as to what the Fed is looking at in terms of data, because headline CPI came in a little bit lower than the previous month on an annualized basis, but the Fed is projecting higher inflation, or they're afraid of inflation not being reflected in the CPI as of yet. So I wonder if they're looking at other coincident indicators that are more timely, or real-time data that may point to a rise in inflation, or just consumer feedback, something.
It's a great question, because you tend to get different outcomes when you actually burden yourself with the facts. Like, why aren't they talking to Andrew Jassy, who was on CNBC yesterday, saying, we're just not seeing it? I mean, if anyone's going to see it ahead of time, it's going to be Amazon. And the fact that he's out there and they're ignoring the real data on the ground. And by the way, I mean, let's say they're right. Okay, I'm willing to be wrong. I'm humble enough to say maybe they're right. Maybe it's going to go up. If they cut 100 basis points and they're wrong, what's so complicated about raising 25 basis points a couple times? It's much easier to quell inflation than it is to get yourself out of deflation. Deflation takes billions of dollars of stimulus packages, massive unemployment, huge amounts of pain in the economy, years of wasted underproductivity. Whereas if you run a little too hot, you can curb that pretty darn quickly. And there's no reason for them to not have that flexible thinking versus, I'm going to be right. Inflation is going to go up. I predict it with my crystal ball. Well, all of his predictions have been wrong so far. So maybe this time he flips the coin and he's right. But the mandate is for them to be data dependent. And right now they're explicitly being prediction dependent. For what reason? I have no idea. I can only speculate, but it's hurting a lot more people than the one person it's intended to.
All right. So we've talked about so far fiscal and monetary policy. So the fiscal side being the big, beautiful bill, and the monetary side being the Fed action or lack of action, shall we say. So what does this mean for an investor? How do these two fiscal and monetary forces play into bond yields first and foremost, and ultimately stocks and fixed income?
Well, the beauty of bond yields right now is the one thing that matters more than anything is the 10-year yield, because that's what mortgage rates are tied to. And Besant is going to solve for that and probably a shadow Fed appointment after the July meeting, if they haven't taken action, is going to solve for that. But what Bessent's going to do, and it's already done, you saw in the last week or so, they put out the changes for the SLR, the bank capital requirements, having to hold less capital against treasuries, which will create more demand for U.S. treasuries at the banks, which will spur more lending. The Treasury then can issue at the short end of the curve and then buy in the longer end of the curve, like they did in 2012, an operation type twist to hold down the 10-year yield. And I think on that basis, and they've anticipated 30 to 70 basis points reduction in the 10-year yield once that's implemented. That should be implemented sometime late this summer. That would bring the 10-year yield down to 350, 370, which is going to bring 30-year mortgage rates down below 6. I think when you see that, you're going to see unlimited demand for housing. And that's a theme that we've positioned ourselves for, not with the home builders, because there'll be a race to bottom in margins, but with the arms dealers, the building suppliers, the QXOs of the world, which has been a big winner for us. That's Brad Jacobs' Beacon Roofing he bought. Now he's doing a couple more tuck-ins. The Stanley Black & Deckers of the world, the Generacs of the world, et cetera, are ancillary ways to play that recovery.
Timeline-wise, when do you think this will happen?
Next 3 months.
Well, how are you positioned?
In terms of the stocks, or in terms of the implementation of the amendments to the SLR and bank capital requirements?
The implementation of the amendments.
Yeah, within the next 2 to 3 months.
Okay. Do you think markets are going to preempt that or react to it afterward?
Well, I think there's an element of that, because if you consider the perception of the big, beautiful bill is financial irresponsibility, that's the way it's being packaged right now. That's the way it's being sold in the media. And yet 10-year yield has been relatively contained around 425. I think there's an offset, what would just be a discrete reaction to the big, beautiful bill is being offset by expectations of what Bessent and Bowman and et cetera are going to be implementing on the bank capital requirement side. And I think that once the bill is passed and we get closer to implementation and it becomes real and people can understand what the increased demand of treasuries, both from this and from the Genius Act with stablecoins, is going to be on U.S. treasuries, I think we're going to be surprised that everyone who was calling for 5% when the 10-year yield was at 480 is going to be shocked that it's moving to 3.5%. And that's usually what happens when everyone gets crowded to one side of the boat.
All right, let's take a look at some of the commentary you've posted recently. This is hedge fund tips, which I encourage everyone to check out. Time for a makeover, stock market and sentiment results. This was posted last week, I think. And underneath there are various video clips of you talking about your market outlooks and your picks. Give us a summary of how sentiment is behaving now with surveys and other data that you're looking at, and whether or not sentiment is an indicator of any buying or selling action that investors should be taking a look at.
Yeah, I think that's great. Thank you for doing that. So the first thing I would say is that, as we know, David, sentiment got completely washed out on April 7th, okay, on the basis of tariff fears. And you saw $1 trillion of sales from CTAs, et cetera, at the exact wrong time. Bank of America put out their fund manager survey of 222 managers with $500 billion under management about a week and a half ago. I was shocked. While sentiment has started to recover, as of a week and a half ago, it's still similar or in the range of levels not seen since the COVID lows and the great financial crisis lows. I mean, you can't make this up. And the market was like 1.5% off of all-time highs a week and a half ago, and managers are still underweight, non-believing, pessimistic. Most of them had been waiting for a retest of the lows, and now they are being forced buyers. Okay, so the shorts have had to cover. They were the first buyers. Now the institutional managers that sold in the hole are being forced in on every positive headline, whether it's a deal today with Vietnam or, Japanese not taking our rice, now taking our rice. I mean, you can't make this stuff up. Or the Canadians dropping the digital services tax and coming back to the table. Every every new headline is going to force more money into the market, and there's still a lot on the sidelines. Then you take global M2 money supply is now at a record. It had been basically flatlining since 2022. So you got liquidity in the market, people off sides on positioning have to chase up to keep their jobs to catch the indices. When you're behind the mark on performance and the indices are ahead of you, what do? You buy the catch-up trade, you buy the laggards, which is why I think the second half is going to be dominated by the 493 versus the 7, Mag 7 rather. And then expectations are still pretty low. You're going into earnings season, they cut expectations from 9.4% earnings growth on March 31st for Q2. It's now down to 5%. So that sets the stage for earnings to beat expectations. We'll see what guidance looks like, but you're seeing C-suite, CEO, CFO confidence coming back, animal spirits coming back, deals coming back, investment coming back. So my expectation is guidance is going to be a little bit better, barring some, crazy town stuff between now and the 9th, which we'll get a taste of, I'm sure. But I think we're going to get more deals announced than we're going to get crazy town. And with that said, it forces more money in. This is that time of year. I think I start to get a little nervous if we push, meaningfully higher in July. Probably start to take a few chips on the table heading into the fall, just for normal volatility and for those things that have reached full intrinsic value at that time.
Let's drill a little bit deeper into your thesis of why the 493 could outperform the Mag 7, the Unmagnificent 493 versus the Magnificent 7. Is this a valuation story? Is this an operating margin story? Is this just sentiment shifting? What is it?
It's a combination of all, but the number one thing that determines the valuation of businesses in the short term, the market is a voting machine based on emotion. In the long, intermediate, and long term, it's a weighing machine based on fundamentals. And if you look at the simple fundamentals of the Mag 7, earnings growth in the first quarter of last year was over 30%. First quarter this year was 27%. That's going to decelerate down to 10.2% in the first quarter of 2026. At the same time, the 493 collectively had negative earnings growth towards the end of last year and first quarter of this year. That is now going to accelerate to 10.3% earnings growth by Q1 of 2026. So effectively, with the Mag 7, you've got collapsing earnings growth because of all the CapEx that they're putting in. And most people say it's offensive spending. I would say it's defensive spending because we don't know the return on investment as of now. It'll probably be substantial, but it's to be determined. And the Unmagnificent 493 is accelerating earnings growth. The problem with the Mag 7 is the multiples have not come down relative to the earnings growth deceleration, and that's a divergence that will play catch up. Whereas the Unmagnificent 493, you can get more earnings growth if you look a couple quarters out for basically half the multiple. And I think all these managers that got caught behind the 8 ball in early April are going to have to play the laggard trade. So what does that mean in terms of the indices? The indices returns could be more subdued in the second half than people are expecting in the current state of euphoria right now. They'll be good, but if you consider that 30-40% of the weight of that index has meaningfully declining earnings growth rates, the fortunes are going to be made, or the big money is going to be made in the other 493, which will have less of an impact on the index appreciation and more of an impact on your portfolio appreciation. I mean, I could see some active managers up 50, 75% in the next 9 to 12 months with the indices up maybe, another 9 to 11%, something in that range. And people will wonder why some stocks feel like they're grinding sideways and doing not much, which is because their earnings growth is decelerating, and others are doubling and tripling because they're playing catch up post-COVID and finally getting back to normalized free cash flow levels.
So, Tom, let's talk about the consumer. I'm curious to see how you think the consumer is going to spend his or her money later on in the year, and whether or not these spending patterns may impact certain industries more than others. I'll give you a few stats first to jump off of. So, as of the latest PCE data we have here, after a decrease in spending overall by $29 billion in May, goods spending fell $49 billion. Services spending rose $19.9 billion. Real PCE, inflation adjusted, declined by 0.3%. That's PCE spending. Other key retail consumer data. Credit card spending per household rose by 0.8% year over year in May. Delinquency rates and charge-offs have been eased slightly. 2025 June retail sales data showed continued resilience in spending. Weak consumer sentiment, however, still lingers in a 0.3% month-over-month decline in real PCE, which is what I just mentioned. So bit of a mixed bag here. Spending less overall, but credit card spending is up. Delinquencies have been written off slightly, so I think people are spending more on their credit cards, but spending less overall. So what does this mean for you?
Well, let's parse that, because what you said was goods spending decelerated. And the reason that goods spending decelerated is because there was a monstrous pull forward prior to tariffs in March, okay? Both with autos, both with retail goods, both with everything under the sun. So goods got a huge pull forward, and we saw it in the numbers prior to what did he call it? Independence Day, or what was it? Was it called
Liberation Day?
Liberation Day. Independence Day is coming up. Liberation Day, prior to Liberation Day. So that's what happened. But now you're seeing services spending up. So they got all the goods that they're going to need ahead of the tariffs. So now they've got this money that where are they spending it? They're spending it in services. Services are actually going up. Second thing you need to keep in mind is that in April, sentiment got completely flushed with the tariffs. So not only did they buy all their stuff up front, but then they were scared because their 401ks were down for a few weeks. So naturally, spending went down. What you have seen in May and June is a rebound, both in UMISH and in CB confidence, a rebound in sentiment now that there seems to be some rationality around tariff policy. And that has been reflected in the rebound in services spending. But the goods, they got to work through all the toilet paper that they bought in March that everyone was afraid was going to be a crazy town. So I think that there's some of these that are a little short-term misleading because of the lagged effect of anticipation of Liberation Day, and then the lagged effect of the fear and uncertainty created during the month of March and certainly April, and now the slow recovery of both. But I did find that stat interesting that the credit card defaults have decelerated, which was also a little bit surprising. And I think that's a function of what we're starting to see the taste of now that we're through the chaos of the first few months, is real wages rising at the lower end. So I think that's going to be a positive trend and a theme for the next 3.5 years is less, Wall Street will do fine, but in the first term of Trump, it wasn't a Wall Street term. It was a Main Street term. Main Street did Wall Street did fine. Main Street did much better on a relative basis in terms of percentage gains from where they were at baseline than Wall Street did. And I think the same is going to be true for the next 3.5 years. I think regular Americans are going to do exceptionally well, starting with this big, beautiful bill and some of the deregulation policies that are to come, the capital requirements, opening up the lending, the credit spigots. I mean, the game is literally just getting started.
If Main Street is going to do better in the foreseeable future, does that mean a shift towards discretionary plays should be the focus for investors?
Yeah, I absolutely think that's right. And I do think a lot of the discretionary stocks have kind of been left for dead. You see some of these turnarounds starting to get a little bit of a glimmer of hope, whether it's Nike, whether it's VF Corp. Some of that's China related, that China is starting to recover as well. More and more stimulus, more and more consumption focused. But I do like that theme. I think housing is going to be a major factor. I think when people can trade out, there are a lot of boomers trapped with millions of equity that don't want to trade down because they don't want to trade a 3% mortgage for 7%, but they will trade a 3 for 5.5 if they can pull $2 million of equity out of their house and put that in investing. So I think you're going to see more of that. I do really like that theme going forward of betting on the consumer, and particularly in those areas that have been beat down quite a bit.
Particularly home building and
home building, some of the consumer discretionary. Nike is not one we own. We would own, but we're going to play the turnaround with Bracken Darrell over at VF Corp, which is a similar type theme. We don't want to get too much exposure there. Estee Lauder is another one that had been left for dead. This is the number one in premium skincare and premium cosmetics around the world, and they got smashed because of China primarily. But the good news is, even though their revenues went down, they've maintained share in all their regions. Even in China, they maintain 99% of their share. So as the consumer comes back, which they will, they'll be getting a larger and larger piece of the pie as their smaller competitors were hurt more during this trough, and they start to recover. I mean, this is a business that has been buying and selling brands. They've got, a dozen plus brands, whether it's Clinique, whether it's MAC, whether it's Dr. Jart, the Korean skincare that's popular with the young kids like my daughters. They've got something for everyone. Aveda at the spas, and they will buy and sell the right brands prospectively. It's a family-controlled business. It's going to be a great recovery as the consumer comes back, not only in China, but globally, and we're seeing more and more of that day by day.
This is an interesting take on investing, because I'm just trying to pull up an article here to show you for this next question. Here we go. Luxury goods spending is falling in the U.S. Actually, all around the world, I'm seeing reports of similar stories here. The wealthy are just cutting back on travel, business class tickets, luxury goods spending, car sales, even in the high-end car market and watch market, you're seeing prices fall for high-end items. I don't know if that's a signal of anything, whether is that a lagging indicator or a leading indicator?
It's 100% lagging. I'm looking at your article as we speak. It said 6.8% decline in April, 8.5% decline in March. Well, those were the people that were hit the most, because they live off of assets, and their assets were down 25% for a few weeks. Of course, they pulled back, and they'll be the first ones to recover as consumer sentiment comes back. And, if you go to any decent restaurant, good luck getting a reservation. I mean, I'm in Orange County here, and on a Tuesday night, I had trouble getting a reservation at a decent restaurant to go out with a few friends. So it is what it is. I mean, they just as quickly as they fell on the uncertainty for 2 weeks, and as long as they didn't puke in the hole like all the CTAs and institutional investors, they're doing just fine, and they've recovered more than what they lost.
Let's finish off in your overall market sentiment, or outlook rather. So this is the S&P versus the Russell. Again, outperformance by the big caps versus the Russell 2000 on a year-to-date basis, 1-year basis, 6 month, and 3 months, any time frame that you want to put it, except the last month when the Russell started outperforming. Is your view that the Russell will continue outperforming throughout the second half of the year, because the 493, the Unmagnificent 493, will start doing better? Is that your view?
I think it'll not only outperform for the second half of the year, I think it'll outperform for the second half of the decade. So I think this is going to be very similar to 2001 to 2006, when small caps dramatically outperformed, value outperformed, i.e. the Unmagnificent 493, I guess is the way you kind of view that mostly today. International outperformed. I think you're going to see a continued weaker dollar, and on a relative basis, like you saw in the first half of this year, international. And I was on your show last year when you couldn't give away an international stock, pounding the table on international versus U.S. That's been massive outperformance year to date. That's going to continue for the second half of the decade. It's not because the U.S. has lost its exceptionalism or any nonsense like that. Same thing happened the second term of Ronald Reagan's presidency. It just runs in 10 to 15-year cycles, and we've had this aberrational ZERP environment, which is over. And everyone keeps looking in the rearview mirror, waiting for what's happened in the last 10 years to continue for the next 10 years, and that's exactly when it doesn't. So you got to zig when others are zagging. Continue to look for opportunity in the 493, small and mid versus large. Look for some focus there. International versus domestic. Continue to have focus there if you didn't start your year off there. you want to start to find some exposure to international for the next 3 to 5 years, and U.S. indices will do just fine. They'll just be slightly more subdued than looking in the rearview mirror. So that's kind of our view. That's how we're positioned. That's our framework. As always, opinion, not advice, but it's worked exceptionally well for us this year, and I think it's going to continue to do so for many years to come.
And final question: the S&P 500. This is the first week that the S&P has retraced and outperformed its previous all-time high, which was back in February, mid-February. So where's it headed from here? Is it too much froth, or is this just the beginning of a new rally?
No, I think we'll push higher here into earnings season, probably the next few weeks, and then I think we got to consolidate some gains, maybe. August, September, October, grind sideways, maybe a little natural pullbacks, et cetera, and probably finish the year a little stronger. So again, if you're hoping that the indices are going to go up another 20% in the next 3 months, I'd be looking under the surface for real opportunities that can double before the end of the year, because the indices, if you're looking for another 20% in the next to finish out the year, I don't think you're going to get anything close to that. But I do think there are enough companies primed that you can find enough doubles that the indices aren't going to matter if you do your work.
Excellent. Thank you very much. Where can we follow you, Thomas?
I'm on X, Twitter, at Hedge Fund Tips, obviously my website, hedgefundtips.com. And we have the number one podcast in a very narrow category, which is the hedge fund category, Hedge Fund Tips with Tom Hayes. Find it on YouTube, find it anywhere you get your podcasts. And TikTok, we're TikTok famous, official Hedge Fund Tips. Everyone loves to follow us over at TikTok. So that's that. And appreciate you very much having me on your show again.
Yeah, appreciate you coming on. Congrats again on your very good calls all throughout the year. So we'll look forward to next time. Have a good 4th of July week, Tom. Take a good day off or a couple days off, and we'll see you again soon.
Appreciate it, David. Bye-bye.
Thank you for watching. Don't forget to like and subscribe.